In this week's update, why prices move by more than we think they should and the smart way to play it. Another overreaction in gold, and Bitcoin remains in limbo. My name is Gary Davis, and as always, this is general advice only in this video, and please remember to subscribe and like to the video. Starting with the market perspective overall, I just want to touch a little bit on the psychology of traders and investors. And our natural inclinations are always to keep doing the same as we've done in a recent period, whether that be recent months or recent years. But that's how our mind operates. We just want to keep doing the same thing. And we often doubt that significant moves can keep going. If a stock price is falling and has been falling for months or years, we sort of intuitively think that, well, it's got to turn around and go up. And the same on the upside. When prices have been running higher and higher, we tend to think that they can't keep going. And so often we miss opportunities to get into extremely strong trends. And we've certainly got that situation at the moment where some sectors of the American market are doing extremely well. They've been running consistently now since early November, when the vaccination program first became evident. So that's the best part of 7.5 months now. And so our natural inclination is to think, well, it can't continue. But, I can tell you that if you look back at history, that it is not only possible for it to continue, it's also likely for it to continue. Now, the mathematical reality, to put some numbers to this, as to why this occurs without things getting overvalued, that's really the important thing, because we naturally think if prices keep going up and up that stocks must be getting more and more overvalued. But that's not the case when you look at growing earnings. So if we look at something like JP Morgan, for instance, in America, which is in the financial sector, the world's biggest bank. So in early November 2020, JP Morgan was trading at $105. They had earnings per share of just under $9, with fairly mild growth expected for 2021 because of COVID. And as a consequence, the market was pricing that stock at a multiple of around 11.6 times, which is towards the lower end of the range for banks. Now, once the vaccination program became evident and markets took a completely different view to the future, then very quickly the earnings expectations for 2021 were ramped up fairly sharply from around $9 a share to $12 a share. And I'll go through an exercise that shows that the market has also been prepared to also raise the PE multiple as well. And so the combination of those two things has seen a 60% gain in the share price, yet the stock, and this is the key point, the stock is not expensive. In fact, it's only sitting in its normal mid-range of its PE multiple, its PE band. So let's take a quick look at that chart to start with. Just before I go there, just highlight Bitcoin so I don't forget it. Look, we're just in a sideways consolidation between a peak of just over 40,000 and a low of just over 30,000. So about a $10,000 range. And for Bitcoin to reassert any sort of positive momentum, it needs to get above this 40,400 level. And until that happens, then all we can say is that it's quite probably just going to continue to go sideways in some sort of consolidation. So that's what I would be looking for with Bitcoin. But just returning now to JP Morgan. So here we are in early November, just as the vaccines were being announced. We had earnings of $9, we had a PE multiple of 11.6, and that gave us a share price of 105. Now you can see that the price has advanced from 105 to currently being at 166, which with this year's earnings of $12 now, the expectation, and it could even come in better than that, because analysts are still ratcheting up their earnings expectations. So it could well be that this $12 gets pushed up higher, and 14 times earnings is not expensive for banks. 16, 17 times is starting to get on the high side for banks. So if earnings were to push up a bit further, let's say to $13, and the multiple was to push up to 16, then we're seeing a price close to $200. So the point here is that just because any stock price has been rising considerably for a significant period of time does not make it overvalued and does not take out of play the possibility of further significant gains. Now, right at the moment, the smart thing to do is to buy the dips. We saw a dip here in January that lasted about 10 days and brought it back to close to the 50-day moving average. We saw another dip in April, which again was related a bit towards inflation fears. Not much of a dip, but again only lasted 7 to 10 days, and to just below the 50-day, and then it took off again. So the smart thing to do would be to wait for another dip to around the 50-day moving average, because that's what's working. Keep it simple. Just do more of what is working now and less of what is not working. So that's one of the key points that I wanted to make today, because there are a lot of sectors in America, and that translates to Australia as well, where there's been very significant rises since November last year. These are the areas that were very much lagging in 2020. There's been a lot of significant gains, and dips in those areas are more likely to be productive and help you produce a profit than trying to guess bottoms in sectors that aren't trending. That's the key point that I want to make today. It's the same story in energy, but perhaps even more so in energy, because production in the States is really ramping up. Inventories are relatively low. Production is ramping up. So the outlook in the energy sector is actually pretty good. So we'll just look at those two overall sectors. So there's XLF, the American financial sector, and that's just a beautiful trend. It's an outstanding trend. And when you see a trend that's as smooth and steady as that, they tend to go on for a lot longer than we would imagine they should. Now let's look at energy. Energy had a bit of a pause over the last few months, and as you would know, I've been cautious on energy for a couple of years, because often the way that the oil price behaves is quite geopolitical and therefore unpredictable. So I'm sort of less enthused about energy because of that unpredictability. Whereas in the finance sector, we know that the environment for the finance sector is pretty robust and it's pretty predictable. But nevertheless, energy is breaking out. So, we can't ignore that as a shorter term trading opportunity. So what about the short term? Well, June is the worst month of the year. If we measure it over the last 20 years and look at the average gain and the number of times that a month is positive or negative, then on either metric, June is the worst month of the year. Now, that doesn't mean that, really nasty things happen. It just means that there's not too many positive things that tend to happen in June. And we tend to get a positive outcome in June only 40% of the time. So that means that 6 times out of 10, June at the index level returns a negative result. Now, that doesn't mean that it will be negative this year, but it just tells you that you've got a bit of a headwind in your face during June, and so you need to be a bit more careful because we don't have that natural buying tailwind. Right now, the economic data is pretty much in Goldilocks territory as far as inflation is concerned. So inflation is the thing that the market is most concerned about, and it's what the market is reacting to almost instantly without too much thought about context. And the economic data, we had a preliminary report on Thursday which spooked the market, that showed that the number of jobs created had escalated beyond expectations. That then got people worrying about inflation and interest rates going up. and that spooked the market. But then on Friday, the official jobs data came out, and it was absolutely fine. In fact, it was less than expectations, which then just reversed the overreaction from Thursday. So the economic data, when we look at it in total, is pretty much in the sweet spot. It's not too strong, it's not too weak. The Fed should be able to continue to maintain their policy stance, and the market just loves where the Fed is at. Low rates, high levels of stimulus, and the likelihood that that's going to continue. That's what the market really likes. So that data is pretty much in the sweet spot for a good, stable market. The second thing that's important is that the savings rate in the US is close to the highest in history, for obvious reasons, because people have been locked down. So we've got a pretty heady mix of good economic data, not that much for the market to worry about really, but it seems to find things in the very short term. And we've got a huge tsunami of money to be spent either in retail land or to be put to work in the stock market. So, the outlook can only be described for the remainder of this year as pretty positive, irrespective of what short-term retractions we might see in the market. So turning to American stocks, the US S&P 500 rose a little bit, was pretty mild. It was only a 4-day week, and we did get a bit of a spook on Thursday. But it remains just a whisker off all-time highs, and there really is no indication there for anything other than small retracements on what we can see at the moment. And we've got more inflation reports coming out next week and the week after, so they can always, if they're unexpectedly high or low, they can always influence the market. But based on what we just saw on Friday, which was that the jobs report came in at less than expectations, then the market's going to be happy with that. So, we can't anticipate what might happen. All we can go on is what is happening at the moment, and that's where we sit. That there isn't any real indication for anything other than small retracements, which is healthy, just takes the froth off the top of the market, stops it getting overheated. But inflation and inflation perceptions remain the main risk. And, that's a bit of a month-by-month proposition at the moment. US dollar was up very slightly. The 10-year yield eased back with that jobs report coming in lower on Friday, back to 1.55, so the market's happy with that. And the VIX is holding at a pretty low level, in fact, at a very low level post-COVID of around 16. So let's take a look at a few charts. We'll start with the S&P. Here's the big picture monthly. So here we are on the daily. We're just a tick off the all-time highs, which was set on the 7th of May, but look, it's only a point or two. You can see the orientation of the moving averages, the green 20, the blue 50, and the red 200-day moving average. They're all stacked up very nicely. The trends are very, very nice. They're holding above the 50-day moving average, which is a real sign of strength. So, it's all looking pretty good at the moment. And then if you drill down within that S&P, you'll find that there are sectors like XLF, that's just a smooth, beautiful, smooth uptrend. The Dow Transports looks the same. And we've got a couple of other sectors also showing very, very smooth progressions. But we've also got some sectors that are showing more volatility and really are just going sideways. So this remains a market that you can certainly benefit by being more targeted, both at the sector level and at the stock level. Turning to the US dollar, you can see we had a bit of a blip on Thursday with that unofficial report that turned out to be really pretty misleading in the end. And then that pretty much washed out on Friday. So the dollar still just holding this key, really big picture, long-term support level. This really is a key level around this 89 mark. And if the US dollar does break that, then I think we'll probably see a sharp move to the downside. But that hasn't happened as yet. The Australian dollar is really just doing the mirror. The iron ore price is still holding up. The Australian current account position is incredibly robust. And, it's really commodities that are holding everything together in Australia at the moment. Just while I'm here, we'll take a look at the ASX 200. So you can see new all-time highs. The previous highs just before COVID hit were around just under 7,200. And we closed at nearly 7,300. And it's a mixture of, we certainly saw some initial strength in materials, but they've cooled off a little bit in the last couple of weeks. But the real strength is in finance. It's been a tremendously strong trend. And also energy that had been very much lagging in Australia, but has really spiked up in the last 3 days in Australia. So that's a lot about a rebound in Woodside. Whether that's sustainable or not, I don't really have an opinion on it, to be honest. I find the trends in America much truer, much more predictable. So just wrapping up, the Australian dollar just a tick over 77 cents, but it was pretty much a roller coaster for all currencies around the world, and our index gained 1.6%. Precious metals now, gold was down $12 to just under $1,900 with about a $54 fluctuation on Thursday and Friday. So the ADP employment report really did spook things, but then the official Labor Department number reversed that, and gold bounced back up again. But it had been down close to 1850 at one stage, so quite a sharp sell-off. And we've still got the next major hurdle for gold at 1960. GDX, reacted exactly as you would expect. Sharp drop Thursday, but as we'll see, remains very much within an upward trending channel. So there's gold on a weekly. So you can see quite a decent range for last week, but ended up closing down only a little bit. And we're still in the upward sloping channel on the daily chart for gold. Silver starting to underperform gold a little bit, because it's really just, we had a real explosion in the middle of 2020, and since then it's really just gone sideways. And GDX also remains within its channel. It had a little peak above the top of the channel in mid-May. Take away that false report on Thursday night, and really gold has just really gone sideways. And or GDX, I should say, has really just gone sideways. And at the moment, what we can say is that there is a strong uptrending channel. We're in the lower half of the channel, and so the path of least resistance for gold stocks is to the upside. Turning to other commodities, copper dropped about 10 cents, but nickel went up a few cents, largely around currency moves. And also zinc is looking very strong, almost doubled since the COVID lows. So zinc is probably the strongest of the base metals in terms of percentage gain. Crude oil, that number is not correct. Sorry, I forgot to adjust that. Crude oil is in the 68s at the moment. In 2020, refining activity in America plunged dramatically from... it dropped by about 40%. So it was quite a dramatic plunge. And as a consequence, because the refineries weren't refining much, then drilling had to stop. And so, the drilling industry just got absolutely murdered in America. But what we're seeing now is a rebound. So definitely demand is increasing, particularly for petrol, because people are out and about more now. And the rebound in refining activity and drilling activity, you look at the number of drill rigs, it's doubled since 2020, but it's still well below where it was at the peak before COVID. So the rebound is only partial so far, but the market is starting to price in a big recovery because it's looking another 6 to 12 months ahead. And that recovery will probably manifest itself. The way the economy is going in America and the way things are going elsewhere, and China's demand is still strong. So the outlook for crude oil is still pretty good. But what OPEC does with pricing is a real unknown. So it's still an area that I'm a little wary of. There's the spot copper chart. You can see we're just getting a consolidation over the last few weeks. There's nickel, something similar, and there's spot zinc. So you can see zinc has been in a very, very strong trend up all year. It's hard to get good zinc exposure in Australia, I find, with a strong bias towards zinc. So wrapping things up, my final thoughts. It's just so important at the moment, I think, to stay on the right side of the trends, because we've got markets around the world that it's not an even advance. It's markets in two halves, if you like. We've got half that's doing really well, trending beautifully, and we've got half that's not. So it's important to stay on the right side of the trend. And I'd really encourage everyone not to just do what you've always done, because it's just so easy. It doesn't require any thinking. You just keep doing what you've always done. But markets, the way they are at the moment, I just don't think we have the luxury of being able to just, stick our head in the sand and do what we've always done. We're probably going to get a worse result because markets have evolved. Now, it's up to everyone to determine their own situation. Whether you're a short-term trader, a longer-term investor, your risk levels, your activity levels, all those sorts of things come into play. So everyone has to make up their own mind here. And all I'm trying to do is stimulate you to think about your own circumstances. And then once you've done that, keep a suitable blend of what's working now. And I think the majority of people's portfolios should be focused on what is working now. Let's make money now. Why be in something that's going to make you money or may make you money next year or the year after? Why not be in things that are making you money now? So I think that should be where the bulk of the portfolio should be. Now, that doesn't mean that you can't own some of your long-term preferences. If you like certain sectors or you like certain stocks and you want to own them for the next 5 years, absolutely fine. Do that. But don't have an entire portfolio full of things that you like for the long term that aren't trending. I just don't think that's a smart thing to do. So I'm just trying to stimulate the thinking process here about what it is you really want, and then where you can get more of what is working into your portfolio now, things that are trending higher right now. Now, we've got more inflation data in the US next Thursday, and then another inflation report, I think, the Thursday after that. So there's plenty of things that are going to keep the market on its toes. Portfolio Analyst last week was a lot about positioning our portfolios for the future. So looking at what was working, looking at what may come back to favour in the future, and positioning accordingly. So I think it was a pretty productive session. Again, I provided a range of buying opportunities and patterns to look at, and obviously the strategy and the portfolio balance issue as well. Now, for this week, there's a sector or two that are looking good for a breakout. So more on that in Portfolio Analyst this week. And anyone that's watching this video that hasn't taken the trial in Portfolio Analyst, then it's $1 for 2 weeks. I think it's money well worth spending. That's it for this week. There's more information on our website, and there's my email address for anyone that wants to contact me. And I'll be back with you next Sunday. Cheers.